Today's lecture will focus on Chapter 16, Financial Management. Remember last class we talked about accounting. Well, accountants count the money, people who are in finance, to make sure the money's getting in and the money goes out. So finance is a function within business that acquires funds for the firm and then manages those funds within the company. So some of the activities included in finance are preparing budgets, cash flow analysis, and planning for expenditures. So the term financial management references the overall job of managing a company's resources to meet its goals and objectives, mostly monetary resources, but other resources as well. So within financial managers, within financial management, you have financial managers. They examine financial data and recommend strategies for improving financial performance. And they are responsible for lots of things, including but not limited to what you see on this slide. You can see who's in finance. The top person is the CFO. He or she then would have people underneath him or her, and you can see some of those people listed on this slide. You can see, what do financial managers do? They do a lot of things regarding money. Companies fail all the time. Many times it has to do with finances. Some reasons why companies fail financially is because they are undercapitalized. That means that they didn't bring in enough money to start the business, insufficient funds to start the business. Second reason is because they don't have good control over the cash flow of the company. Too much money is going out and not enough money is going in. Remember, cash is the lifeblood of a business. Third, they have inadequate expense control. There's too many expenses and they don't have a good handle on that. Well, the head person of the company is the CFO. He or she will have concerns both on a macro level or a big picture level and on a micro level or a smaller level. From a macro perspective, top concerns of the company's chief financial is there demand for the product or goods or services that I provide? What are the government policies in terms of taxes and in terms of spending? What type of pressures am I facing from my direct competitors? How are the credit markets? Do I have the ability to go out and borrow money, and how low are interest rates? And is the globe financially stable? Concerns that a CFO will have from a micro or smaller or just within his own business perspective is, can I maintain my margins, which means that's how profitable we are for selling our goods and services. Or can I forecast results not only now but going forward? And costs such as healthcare and other things such as making sure that we have enough working capital. So there are key steps to financial planning. Number one is to forecast the company's short-term and long-term financial needs. So it's established needs. Number two is then to develop budgets to meet those needs mentioned in step one. And finally, step three is to establish controls financially to make sure the company is achieving its overall goals. We'll talk about each of these three steps in the next few slides. So the first thing was to establish forecasts. And forecasts can be short-term or long-term in nature. So short-term forecasts are less than a year, whereas long-term forecasts are longer than a year. Whether or not it's short-term or long-term, you should have cash flow, which predicts the cash inflows and outflows for those short-term and long-term periods. Once we forecast our needs in step one, we move to step two, budgeting. And budgeting simply sets forth management's expectations for the revenues coming in and allocates the use of specific resources to then use those revenues properly. And so budgets are heavily dependent upon the financial statements we talked about last chapter, the balance sheet, the income statement, and the statement of cash flows, as well as the short and long-term financial forecasts that people in finance produce. There are different types of budgets. The first type of budget is a capital budget that highlights the company's spending plans for such things as major asset purchase, and usually that require large amounts of money in order to purchase. A cash budget, again, estimates the cash inflows and outflows during a particular period, such as like a month or a quarter. Both the capital budget and the cash budget tie into the master budget that ties in together all the company's other budgets and summarizes financial activities. The next slide will give you an example of the master budget in the middle. Everything ties in. So the financial plan up in step 1 and the budgets in step 2 below. The third step, remember, was establishing financial control, and that's a continuous process where a company periodically compares actual revenues and costs and expenses with that which was budgeted. So what are key needs? Now we're going to move on to a new section called operational funds, the money need to actually operate the business. So what are some key needs to actually operate the business? So you got to be able to control your credit operations. You got to get the required inventory to make the goods that you're selling or to provide the services. And you got to make expenditures if you got to buy equipment, etc., land. What are sources of financing operations? Well, it'll either be debt or equity financing. Debt means borrowing. So debt financing is funds raised through various forms of borrowing. As you know, when you borrow, you must repay that money. Equity means ownership. So with equity funding, it's funds raised from within the company through the sale of ownership. If it's a corporation, it sells stock. Equity does not have to be paid back. In addition, financing will be for a short term, for a year or less, or for a long term, for a year or more. The next slide points out why companies would need either short-term financing or long-term financing. Take a minute to look at that. First, we're going to look at several slides dealing with types of short-term financing. Well, the one that everyone uses, even you may not know the technical name for it, is trade credit. And that's where you buy goods or services now and pay for them later. And oftentimes, you'll see such terms with trade credit as 210 or net 30. That means if you pay the bill within 10 days, you get 2% off, or you have 30 days to pay the entire full bill. Sometimes, if trade credit goes wrong, it escalates to a promissory note. That's now a written contract agreeing to pay a supplier a specific sum of money at a definite date. So when you haven't been, been dealing on credit and you haven't been paying on time, oftentimes it'll now have to be escalated to a promissory note. Oftentimes you go to family or friends, and as we've talked about before, you should only use family and friends to obtain capital to operate your finances on a short-term basis as a last resort, and you should treat it as a contract. Problem is, small businesses generally have a hard time getting short-term financing, especially from banks and other financial institutions. They will, if they do offer short-term financing, it's usually not to small businesses, but to usually bigger, more established businesses. There are different types of loans, though, that will be given out on a short-term basis. Loans will either be secured or unsecured. Secured means that the loan is backed by collateral or other property. Unsecured means the opposite. Oftentimes, organizations or businesses have what's called a line of credit, and that's a given amount of money that the bank will provide you if the funds are available. Whereas a revolving line of credit is a type of line of credit that's guaranteed. It's always available, but because it's always available, it comes with a fee. Factoring is another type of short-term financing. Factoring is the process of selling your accounts receivable or what's owed to you for cash. So for instance, if you're having a hard time collecting from a vendor that owes you $100, you may factor that off to someone for $20, and now you at least got $20, and the other person will try to collect the $100 who paid you the $20. Commercial paper is another type of short-term financing for operations. It's usually only established by larger companies. Like for instance, Northrop Grumman here in the Valley will issue commercial paper. It's unsecured type of written promissory notes, usually in amounts greater than $100,000. They come due and usually in less than 3/4 of a year. Finally, as a last resort, businesses sometimes will obtain short-term financing through the use of credit cards. And as you know, the rates on credit cards can be oppressively high. Now let's spend a few moments looking at long-term ways of financing operations. And before you do this, you should answer 3 important questions. 1, what is the company's long-term goals and objectives? 2nd, once we've identified that, what funds do we need to achieve the firm's long-term goals and objectives? 3, what sources will be best available to meet those goals and objectives? So one way to get long-term financing is through a loan. They can usually come anytime over a year, so it can go up to 20 years. So a promissory note for a longer term basis is a term loan agreement. So remember, short term was a promissory note, longer term is a term loan agreement. It's in writing. A great reason why companies like to borrow long term is that they can write off the interest as tax deductible on their business tax return. Again, just like with short-term financing, long-term financing will either be secured or unsecured. So this is a really good study slide for your exam, and look at the different types of financing. On the left side, you'll see debt. On the right side, you'll see equity. And you can see a lot of the differences between the two. So remember, with debt, you got to pay back for repayment, but stocks have no maturity date. And you can see there's tax benefits as well. Oftentimes, businesses use leverage. That's raising funds through borrowing to increase the company's rate of return. And the best example I can give you that is Google. Google, up till a few years ago, had no debt. But recently, they used leverage, or they sold a bunch of bonds or borrowed $1 billion at 1% interest, which means they only had to pay it back at 1%. Why would a company that has billions of dollars in the bank borrow money? Because if they only had to pay it back at 1%, but they could take that $1 billion that they borrowed and make 15% on the money, that's good use of leverage of somebody else's money. I want to take a few minutes to look at slide 50. And let's look here. You know this is a corporation because it says stockholders' equity. And we're going to look at something from 2 standpoints. On the left, taking on additional debt or borrowing money, and on the right, taking on additional equity by selling more stock. Let's look at additional debt first. So the company started with shareholders' equity of $500,000, and they borrowed $200,000 at 8% interest. since it's, remember, they're not selling ownership here, they're selling debt here. So the shareholder equity started at 500,000 and it remains at $500,000. Well, the company made $100,000 of gross profit, but they, remember, they had to pay back the bondholders at 8% interest. Well, 8% of 200,000 is 16,000. So the gross profit of 100,000 minus the bond interest of 16,000 leaves the company with an operating profit of $84,000. If we divide operating profit by shareholders' equity, or 84,000 divided by 500,000, you see a return of equity of 16.8%. On the right side, here, instead of selling bonds, they sold more stock. They sold $200,000 of stock. So the shareholders' equity started at 500,000, but because they sold 200,000 more in stock, now equity is 700,000. The company made the same $100,000 a year, but they don't have to pay interest because there is no bonds. So their gross profit and their operating profit's $100,000. But notice the return on equity is lower than it is for debt. Here we divide the $100,000 of operating profit divided by the $700,000 of shareholder equity. And you can see that's a rate of return on equity of only 14.3%. That means the owners are making less on their money. So here, borrowing the $200,000, yes, it was less operating profit, but the owners made more money than they did by selling more of ownership. This concludes our lecture on Chapter 16, Financial Management.